Okay, I think we'll go ahead and get going here. Thank you all for joining us today. I'd like to welcome you to today's webinar. It's a 2020 Year-End Tax and Audit Review. The webinar is part of our webinar series on key mortgage industry topics for our clients and friends in the industry. A couple of housekeeping items. Please feel free to type any questions that you have in the chat area. We're going to do our best to get to all of them. In the event that we don't worry, we will follow up. You'll also receive a recording of the webinar via email. Keep an eye out for that either later today or tomorrow. Last, like I mentioned at the top of this is going to be the first of an entire webinar series. So if you guys have anything that's top of mind that you would like to suggest for us in the future to hold the webinar regarding, we would love to hear from you. So feel free to type that in the chat box or reach out to a team member. That being said, I'd like to introduce John Chekowitz, our tax director, Dustin Pfluger, he's our mortgage banking partner, and Mark Wilson, managing partner. They're here to discuss the 2020 year-end and tax review, as well as a look forward at what 2021 may hold. With that, I'll turn it over to the experts.
Great, thanks, Casey. That, by the way, Casey is our Director of Business Development. I'm sure some of you have met her along the way. And also you might see up there or hear from Rachel Daly, who was our Director of Marketing. So she's been key in putting these together. So you might hear from the two of them. So thank you very much for joining us today. We really are trying to make sure we're providing enough value to each one of our clients. And so we figured this is a great time. 2020 has been an unusual year, to say the least. And there's a lot of last minute planning issues that we thought we should touch on. But like Casey said, we really want you to participate. So ask questions as much as you feel that you need to. I think we put together a kind of a wireframe type of agenda, but it will move based on your questions. So please participate. So with that, let's jump into the CARES Act that was passed earlier this year. And there's lots of different things in there. The hottest topic that we're reading about right now, and this is constantly coming up, and our questions we're getting is the PPP loan. There's the one that was passed, and there's another round of that coming up. So I want to turn this over to Dustin and John. Let's talk through a couple of the issues related to the PPP loan, and let's touch on the deductibility of the expenses. And I'll let go ahead, John, take that one at first. Let's talk through the tax issues that are related to the PPP, and then we'll come back to Dustin for a couple follow-ups.
Yeah, so first and foremost, the the question of whether or not the deductions associated with the PPP funds, whether or not they are deductible, the IRS has ruled on that and determined that they, as of now, are not deductible. There has been some pushback from the CPA community and other organizations that urging Congress to issue a technical correction to make them deductible, and there's been pushback from President Biden to make them deductible. But as of this time right now, the authority is that they are not deductible, and the only out on that to be able to deduct expenses associated with that is to irrevocably decline forgiveness, which you do in writing when you file your 2020 tax return. Obviously, we're still in December. Many of our clients are going to be filing mid-2021, so that's a lot of time between now and then, and there's a lot of opportunities for that to change. So I say for tax planning right now, if you're looking forward to the future and trying to determine estimated tax payments and cash requirements, plan on them not being deductible, but there's a good chance that could change. There are some who say that you can take a position that they should be deductible. There's some authority behind that. I won't go into the specifics of the arguments behind that, but there is some solid authority that says that you could take a position that they are deductible. And if you do that, we'd recommend you disclose that position, of course, to avoid certain types of penalties on your return.
Yeah, I know, and I remember, and I think you guys can, when it first came out, there was this idea that this money was going to be provided and it would not be taxable. But in a sense, obviously, if you can't deduct the expenses that you spent the money on, it therefore makes it taxable. So we'll see how that goes. I know there's a lot of talk, like you said, and there's some glimmer of hope that they're going to change that position. And I think it'll be interesting to see how that goes. It'd be a permanent difference on your tax versus book. Which brings me up to another question, or maybe I can pitch this over to you, Dustin. What are some of the audit issues related to the PPP loan, how it's booked, and some other items that really should be considered?
Well, yeah, no, that's a good question. I think, most of our clients we've talked through this issue with probably in length now throughout the year. I mean, I won't go into too much detail over the different, but pretty much you can either count for it as traditional debt, where you record it on your balance sheet, you keep it on your balance sheet until you get that official forgiveness from the SBA. And then the second way is you account for it under what they call grant accounting. And so how that works is you, again, record it as traditional debt, but as you meet the qualifications of what they're calling the grant, so as you meet those qualifications, then you can release it off your balance sheet and into the P&L as other income. We've seen clients, record it both ways. And yeah, I mean, I think on the audit side of things, obviously, year end, if it's still on your balance sheet, well, regardless if it's on your balance sheet or not, we're going to need to see, the note from the SBA or from your lender to pretty much vouch it out and make sure, it exists, it's the right amount, all that kind of stuff. If you're taking grant accounting, it's a little bit, trickier, the disclosure, you have to have a little bit more disclosures, and really where it gets a little trickier is if you do fully believe that you're going to get forgiveness is what it comes down to. So, I think that's the only holdup.
So if I'm a mortgage bank, why would I choose grant accounting versus just leaving it on as a loan until it is actually forgiven? Why would I allocate that in a grant?
Well, yeah, I mean, I think the main I think the main thing is to pretty much match your revenues with your expenses. I mean, if you go back to the, old matching principles that we all learned in Accounting 101, I mean, you have expenses that you're incurring under this grant or under this loan, let's say. And, if you don't use grant accounting, then you're going to have a mismatch. You're going to, have the expenses for book purposes in one period, and you're going to have the revenue for another period, because I mean, so what, we're sitting at December 15th, and I don't think we've heard of one mortgage company that's gotten it officially forgiven. So as of now, that wouldn't match. I mean, you wouldn't have it matching monthly, much less for the entire year now. So yeah.
So it'd be a matching issue, and also it increased the net worth of the independent banker, right? So by using the grant method, you have higher net worth. However, I will say, there's a lot of talk about what would be the more conservative approach. And I think the more conservative approach would be to leave it as a liability until things are settled. Would you agree with that?
Yeah. I mean, especially because, and we can get into a little bit of the forgiveness stuff here, especially with some of the, the recent, stuff that's come out on forgiveness. And, I think some of y'all are aware that, if you have a loan over $2 million, they came out and said it was going to be audited. I think that's been very clear for a long time. The tricky thing with forgiveness is we still don't know. We still don't know what's going to happen. I mean, we all think it's going to get forgiven, but they did come out with the 3509 form, which is a new form that you're required to fill out and return to your banker within 10 days of receiving it from the banker. And what the 3509 form does, 3508 is your forgiveness application. 3509 is pretty much a necessity form. And if you have a loan over $2 million, you're going to have to go through and document, the necessity. And we won't obviously bore you with pulling stuff up and, showing you stuff and that kind of thing, but it's pretty much covers two main topics, and it's kind of a business activity assessment is topic one. And then topic two is like a liquidity assessment. And where this gets kind of hard, I sat on a panel last week at the Tax and Accounting conference, and we went through this, and as you're documenting it, that some of the numbers just look, I mean, they look off, because you're having to document, I think it's like March compared to compared to forgiveness time frame, stuff like that, which, everybody's aware that where you were at in March is much different than where you're at now, and in the positive, so what we're recommending people do is obviously put in, all the documentation it requires. Don't, put all that in true and accurate, but on each of the sections, there's a area that you can put other, and you can describe up to 1,000 words. And so, in there, I think is where you document what's happened in both business activity, which would be, document where you were in March, where with forbearances, knowing, what was happening there, with, the investors, the secondary market, kind of drying up in certain, places in the market, whether it's non-QM or Qbi stuff. So, document all of that in that section and what happened in that month. And then there's a liquidity section too. And in that section, document, everything from, margin calls, what was happening there. Half of y'all's liquidity went away and overnight. Document what, the hedge losses that were happening. Document that you really have no other sources of liquidity. If you think about a traditional mortgage bank, you guys have warehouse lines of credit and you have your own owner's pockets, and that's, what it comes down to. So documenting stuff like that, the one key thing.
Even MSR lines, right? So we had MSR lines looking at the servicing values and having challenges with those loans. So there was a lot, like remembering back to that time and documenting it, I think is important. But go ahead. I'm sorry.
Yeah, no. That's a great point. And that actually jogged my memory too, of just warehouse lines. Most times in a period of crunch, you can request a line increase, and usually it'll get granted. But warehouse banks were doing that in March and April. They were justifiably a little hesitant on what was going on. And and then the last piece of liquidity, one thing I would note just when you're doing your calculations, make sure that you do exclude out all your restricted cash. So whether it's restricted by a warehouse bank, whether it's restricted in a margin call account, or if it's restricted for escrows. If it's escrows, it's not technically your cash. So make sure you exclude that from your liquidity, because that shouldn't count. So I think that's it. I think those are big things on that form, and just getting, that documented and that necessity documented.
Yeah, and I'll tell you what, we're getting. I'm sure people on this call and some that are not, they're very concerned over this issue. It is a big issue. The forgiveness portion of this is really going to be important. I will tell everybody on the call, we're actively working on that storyline to make sure that we can help support that. So if you need additional help, you want us to share some color about the industry as a whole, I think, we'll be a good resource for that. And I know we're actually helping a few people with the application itself. And I know that some of the smaller PPP, they've got confirmation of forgiveness, but our mortgage bankers, the bigger ones, we haven't really seen any approvals come through yet, have we, that about, Dustin or John? Have you received anything from our clients confirming?
Yeah, not on the bigger, the bigger than $2 million loans.
No, and that's also industry wide. I think everybody knows this is a very close industry, and just like you guys, we stay in touch with all the our accounting competitors, and we haven't. We asked that question consistently, and nobody across the big firms have seen a mortgage company get it forgiven yet, or a big one over $2 million get that forgiven yet.
Have we heard of anybody getting the 10-day letter yet? 10 days to reply for the 3509.
I don't think any.
Go ahead,
well, I don't think any of our clients have, no, but we have heard of a couple other mortgage companies with around yes, getting that form and needing to apply.
Okay. All right. Well, thanks, guys. Let's go back to the CARE. We're talking about the CARES Act, but obviously a big portion, one that affects a lot of our clients who did receive the PPP. So we want to spend an appropriate amount of time. John, other things in the CARES Act you want to talk about? I know there were payroll tax deferrals, payroll tax credits. There were some net operating loss differences. So maybe you can talk through that a little bit. They rolled back some, I always call it 179 type of write-off, some other capital asset purchases. Maybe you can talk through the various items that were also contained in the CARES Act.
Yeah, absolutely. So I'll just kind of go through them quickly and touch on the high level on the issues, and then we can dive into things more deeply if you want. So there's an employee retention credit for retaining employees. Probably doesn't apply to a lot of our clients because they received a PPP loan. You are not eligible for the retention credit if you got a PPP loan. There are the family leave and sick leave credits, which are claimed in the form of payroll tax credits. So when you're making your either quarterly payroll tax payments or bi-weekly or weekly payroll tax deposits, that's where you claim those. And those are effectively for, paying for sick leave for either a family member or somebody who is looking after a family member. There's a payroll tax deferral option, which covers the employer's portion of the FICA tax, the 6.2% FICA tax. You can defer that between March 27, 2020 and 12/31/20, and it's due back to the government by December 31st of 2021 in half, and then the second half by December 31st, 2022. So that's a lot to do with the payroll taxes there. A big surprise, or just a big benefit, was the net operating loss carrybacks. The net operating loss carrybacks typically are carried back 2 years, and the CARES Act allows carryback up to 5 years for NOLs arising in tax years 2018, 19, or 20. So if you have a substantial loss, which I think many mortgage banks are not going to be in that boat right now, but if that is the case, there is the opportunity to carry it back up to carry it back 5 years, starting with the 5th year back and then moving forward. And unless you can relinquish the credit, or you can relinquish the carryback, you have to relinquish the carryback on your timely filed tax return. And we can talk about bonus depreciation, or accelerating deductions. There was so the CARES Act, what it did was it issued a technical correction for what's called qualified improvement property. So qualified improvement property is a non-residential 15-year property. So we're talking about non-structural, non-infrastructural commercial property like tenant improvements. And what the CARES Act effectively did was it made those types of property into 15-year property, which made them eligible for bonus depreciation. Bonus depreciation meaning that you can deduct the full value of them in the year that they're acquired. So that was a big thing that I think is going to affect a lot of clients who have buildings, and they're doing tenant improvements in those buildings. Likewise, it expanded bonus depreciation rules through the Tax Cuts and Jobs Act a couple of years ago. So there's a lot more leniency in what you can write off at the end of the year. Pretty much anything that has a useful life of 15 years or less can be written off in the year that it's acquired. So whether or not, sorry, go ahead.
No, go ahead. Sorry, I didn't interrupt you. I was just going to say, but essentially, so just make sure that those things are coded correctly in your accounting ledger. Right. Make sure we know about that. I think at the end of the day, know that we're looking at that, and there's some additional opportunities for that. In the CARES Act itself, if you didn't take the PPP loan or money, definitely on those credits, there's some opportunities there. I think a lot of the payroll companies are paying attention to that too, and helping with that reporting. As well as the PPP forgiveness portion also, right? I mean, and I didn't mean to interrupt you, but go ahead.
No, that's absolutely right. I mean, a lot of those credits are addressed at the payroll tax level, so that the payroll tax companies have all become experts in that, and there's a lot of reporting that goes into that. So absolutely, most clients are going to be using full service payroll company of some kind, and they should directly interact with them, and then loop us in that conversation if there's any lack of clarity. But going back to the bonus depreciation issue and coding for the books, taxpayers with applicable financial statements, which is GAAP audited financial statements, should typically code assets that are greater than $5,000 as capitalize them on the balance sheet. That's they adopt that as a capitalization policy. That's a statutory rule that the IRS has, that applicable financial statements that they capitalize assets greater than $5,000. Anything less than that can be booked straight to the P&L and deducted. So the issue of bonus depreciation doesn't even come into play for assets below that limit.
All right, cool.
Yeah, I think that's the highlights on the CARES Act.
That's great. We'll come up with towards the end of the webinar, we'll go up some of our tips and tricks for last minute tax planning, things to kind of consider towards the end of the year. We'll come up with a little bit later, but I want to switch gears and talk a little bit over or about some specific mortgage issues. What are the main fair value issues we're seeing related to interest rate lock commitments this year? And I'll start with Dustin a little bit, talk about what's going on there, and then how that relates to really important tax considerations. We'll switch back to John. So actually, either one of you can start off, but what are some big issues we really need to be looking at this year?
Yeah, no, I think I can start with book, because I think book probably comes first, and then John can talk tax. I mean, I think if you just think through it. So I think with the book stuff, I mean, obviously pipelines are large this year, especially probably compared to the end of 2019. Which means much higher net worth, much higher unrealized gain related to that stuff. So that's the obvious issue. That the one issue that we've seen kind of in the last 2 months kind of take hold, which was an interesting one, is your hedge providers that we've talked to are starting to build in the adverse market fee. So some of you guys might have seen a drop in either October or November in that fair value, and it's because they built in that 50% and adverse market fee. Besides that, I mean, I think it's the same thing as every year. I mean, I think the biggest hot issue is just cost to complete. And what's going into that calculation, how detailed you get it. I mean, I think it's still a gray area of accounting. There's still a hot issue, but it's just, I think some people are getting a little, we've talked about it now for probably 5 years straight. So I think, people are probably got it by now, but you just remember to be backing out, cost to complete. On
the open portion of the pipeline, right? The funded not sold, you probably realize almost 100% of the expenses associated with that. But yeah,
that's a very good point, because we've actually had a few clients that have actually built in a cost to complete in their closed portion, and then have also accrued commissions and stuff like that. So they're double counting those expenses.
Best efforts too. You have any thoughts on that? Like if you have a BE lock versus mandatory, it's the same.
I'm sorry, you broke. Yeah. Sorry, you broke up there for just a second. But yes, if it's best efforts versus mandatory, yeah. I mean, the one unique thing with best efforts is that you're gonna most likely have to build in a model for pull through, and figure that out. I mean, I guess some hedge firms you'll throw that to, and they can track it. But just make sure you're modeling out pull through, have something reasonable there.
Yeah, and I think in the non-QM space, so obviously regardless of product type, consistency is really important. You treat this type of asset the same regardless of product type or type of lock. I think that's the one message we always want to get across. I think a lot of clients don't, that for whatever reason they think it's a different set of rules depending upon the product type. But go ahead.
Yeah, no, that's a great point. I mean the best efforts loans for a while, probably 8 years ago, a lot of people didn't put those on their books. I mean, I think most people have started to value those at fair value. They still are considered a derivative, so they should, and if it's a derivative asset, it's required to be valued at fair value. You don't have an option like your closed pipeline, where there's a fair value election on those. But And then the last piece of cost to complete, just, we always get the question, well, what do we include? I mean, that's, pretty much just, come up with a justifiable method, it definitely have commissions in there. I mean, that's obviously the biggest piece. And then from there, from there, you need to be, other direct cost. I mean, there's some thoughts out there in the industry from various peoples that, people that you should, be allocating overhead and different stuff like that. But that's not GAAP right now. So don't do that. I mean, but any direct cost you can build into that calculation. So,
Yeah.
so those are the big pieces, I think.
Yeah, you guys make sure you ask questions on this particular, any of these topics as they come up. I want to make sure we're not missing anything particular. Okay, so we have had, after we got through that first part of the year, interest rates stayed low, record production year for most of our clients, lots of profit. This asset in particular, your pipeline most likely is going to be higher at the end of this year than you started, so that's going to hit your P&L. You also have servicing issues related to the fair value of servicing. John, what are we seeing in tax, and what are some particular issues we should be paying attention to make sure our clients are aware of?
Yeah. Yeah. So in general, taxpayers are required to report in conformity with their financial statements. That's Internal Revenue Code 451. The IRS released specific guidance that exempts mortgages from 451 because they're subject to a special method of accounting. That special method of accounting is the mark-to-market method under 475. Generally you're marking the securities on the books to their fair value on the balance sheet and including that in taxable income for the period. There's an argument to be made that interest rate locks are not a security and therefore do not fall under 475. So most of our clients take the position that those are not included. So any change in the value of the interest rate locks, that pipeline from the beginning to the end of the year would be a book to tax difference on the tax return. So the changes in the balance of that account only really affect the tax return to the extent that they move from the open pipeline into closed loans held for sale. Because loans held for sale are specifically included in the definition of a security and therefore are taxable on the tax return.
That's good. What did either one of your thoughts? We had that adverse fee that came in towards, or it's actually hitting now, right? And we saw it in the pipelines and the fair value entries that were made. We saw a lot of our clients take somewhat of a reduction from month over month valuation, and the forbearance issue a little bit this year, and looking at the overall risk of loans. Are we seeing anybody adjust their allowance for loss, loan loss allowances or anything like that? Is that coming up at all this year? Are we seeing that, or are we having clients talking about it?
I mean, it was a topic in one of our panels last week, accounting and finance. And I mean, I can't speak specifically. I think we've talked to a few that are adjusting it. I mean, if you're not, I mean, you should be taking it into account. Obviously, it's part of part of your model on what you think you're gonna lose in the foreseeable future. So yeah, I mean, I think we should be taking that into account this year. And I mean, again, production's up, so you would expect that loan loss to be up just regardless, if you're doing it on like a model of basis points of production type thing. So yeah, that's a good point.
Yeah, and I would wonder, I would look at your rate of EPOs or mistakes that are we obviously we don't want to see that in our clients, but I think it's something that clients sometimes overlook. They've always done it a certain way, or they haven't really looked at it. And, I think a lot of clients this year are just trying to get through their pipeline, because they've had just these record years. But it's definitely something we're going to ask about when we're out there doing your audit this year. So how are you going to plan for the future, and what's that look like? And have you taken a closer look at the potential loss? And we obviously hope that doesn't happen, but something to consider. Okay, let's see. We talked about the value in the pipelines in October, November. John, what are the main differences we see from book to tax differences in our mortgage banking clients? What's some of the biggest differences that are either permanent or temporary that we see?
Yeah, so I touched on one just a minute ago with regard to the interest rate locks and the accrual of revenue on the open pipeline. So that's typically a book to tax difference and can vary, from year to year. Sometimes it results in a reduction. Sometimes it results in an increase, depending on if the pipeline is expanding or contracting from beginning to the end of year. Also, a significant difference is the accrual of revenue with respect to mortgage servicing rights. For book purposes, you're accruing revenue based on the fair value of the mortgage servicing rights, and the IRS actually has authority on this, specifically Revenue Ruling 9150 for any of those who want to write that down, with respect to the amount of accrual that can be backed out for book purposes, to the extent that it represents reasonable compensation for those MSRs. They specifically list between 25 and 44 basis points, depending on the type of the loan, and those amounts are effectively backed out and recognized as received. To the extent that
the SX as excess servicing value, or is that what you're talking about, or what?
Yes, correct. So yeah, so in that respect, there would be income to recognize to the extent that they exceed reasonable compensation, the compensatory portion of the MSRs, which would effectively represent interest, and those would be picked up on the tax return.
Yeah, and then can you touch on a little bit or remind people the value of the tax strategy with servicing that asset versus selling it? What's some of the tax?
Yeah, well, so if you're servicing, if you retain an asset for servicing and you hold it for more than 1 year, to the extent that the value of it that it's sold for exceeds the original both compensatory and excess portion that you already picked up the income on, because you have basis in that, that excess portion would be treated as goodwill, which is subject to capital gain treatment. So if it's held for more than 12 months, in that case, you can make an argument for long-term capital gain treatment. So there could be some reduction strategy associated with that.
Awesome. All right, and now let's switch gears a little bit on the QBI. First of all, if you will define what QBI is to our clients, just real quick and like one sentence or so, what that is, and then what mortgage companies are eligible for the QBI deduction.
Yeah, so QBI is it's a deduction that's picked up on the individual tax return. So pass-through entities get it, and what it effectively is it's a 20% deduction on net business income. That's in a nutshell. Without, I mean, it gets much more complicated that with respect to phase outs and exceptions to phase outs and things like that. But that's generally what it is. Your net income on your tax return, Schedule K, that flows over to your individual return. You can take the combined total of all of your business activities, your pass-through business activities, and Schedule C activities, and take 20% of that and deduct it on the tax return.
And which of our mortgage companies would be eligible for that QBI deduction?
Yeah, so there's a rule with regard to a phase out. So if income's above $315,000, a phase out applies, but there are exceptions to the phase out. The main exception to the phase out is the extent to which 50% of wages paid by the business exceeds the potential QBI deduction. That exception to the phase out does not apply if you're what's considered a service business or a specified service trader business under the code. And there was authority released about a year after the passage of the Tax Cuts and Jobs Act, which effectively gave mortgage banks the ability not to be considered service businesses. So they are in general, most of our clients are going to be eligible for the Qbi deduction because they pay a lot of wages. They're closing loans. A good portion of that revenue goes to loan officers in the form of LO comp, and it's all W-2, and they're getting an exception to the phase out. So I would be surprised to see any circumstances where non-C corporation businesses that are mortgage banks do not get the Qbi deduction. That would be really rare.
Got it. Okay, cool. And then a couple rapid fire things here. We've had, like we said, record production. Loan officers are having record years. Managers are. I know we're doing year-end planning for a lot of clients. Talk to me a little bit about accruing year-end bonuses for employees and their deductibility.
Yeah, so the general rule, and for anybody who wants to write down the authority, is Revenue Ruling 2011-29. A liability accrued in 1 year and paid by the 15th day of the third month of the following year is deductible as long as the amount is fixed, was earned during that year, and the employee is employed when they're paid. So if it's accrued and then between the time the end of the year and the time that it's paid, they leave the company, they do not revert back to the employer. They have to be reallocated elsewhere. There is also some authority that considers this, it's the same revenue that effectively states that this may constitute a change in accounting method by accounting for bonuses this way. So there may be a filing requirement associated with that. So you just have to consider that carefully. I mean, there's a number of deeper issues to look at on that.
Yeah. I would say that, vast majority of our clients who pay out bonuses or even commissions, they're earned in that period. If they're accrued by the end of the month, it gets paid out in the following month, no problem, right? I mean, that's typically the way.
15th day of the third month following.
Yeah, 15th day. Yeah, right. You're right. 15th day of the third. Okay. So that's a nice little planning strategy if that's part of it.
Absolutely. Yeah. Especially in a year with increasing income. Absolutely.
Yeah. Okay. And then what about, any other key things to consider as it relates to this particular year? Any other tax planning accruals that should be looked at? Maybe the hedge position. Maybe could you close out your hedge position at a loss, deduct it in the current year? I mean, what are you seeing, or what are you talking with clients about?
Yeah, I mean, you could absolutely do that. If you have a hedge position that if you closed it out now would result in, in having to pay out in cash to cover those losses on the account, then those would be deductible. They're only a part of a book to tax difference to the extent that they stay in that derivative asset account that is that you're accruing for as part of the open pipeline. So if you close out the hedge position and that can be picked up and recognized on the tax return. So definitely a planning opportunity with that.
Is that different than the accrual though? I mean, or would we pick that up in the accrual?
Well, no, I mean, you're booking the change in the value, as on the books, but you're until you're required to cover the position in cash. If you're shorting something in the market, for example, if you have to close that out and cover that with cash, that's going to hit the P&L, and that won't get backed out as part of the a book to tax adjustments, because it's going to be not be part of the derivative asset account.
No. Dustin, do you have anything to add to that particular conversation that relates to the audit considerations?
Well, yeah, no. John and I have talked about this a little bit in the past. It was actually brought to us, by a client that was, and it was an interesting thought, is that, if they close out of the trade, if they've closed out, that's no longer a derivative asset. That's just a payable. I mean, if they've closed out of it and haven't settled until after the year end, so they'll, those trades have, definite settlement dates. They have, right now we're looking at, January and February settlement dates. So if they close out of it and then they have a payable, and at that point, it's just a normal payable and run through like a normal payable. I mean, for both accounting and tax purposes, both, books and stuff like that. So, no, I think it is, a good strategy if you're going to, be on, and now you do incur some cost, obviously, with closing out trades and doing stuff like that early. But it could be a good strategy to realize some of those hedge losses in this year and not push them into next year. Because if it's still sitting in your derivative at the change in your fair value, then obviously that's not getting, that's getting backed out for tax purposes. So.
Cool. Thanks for that. Now, let's talk about a couple of the other year-end audit issues as it relates to Ginnie Mae and other related issues. I know we had forbearance issues early in the year. A lot of people are talking about PTAP and some other things. Maybe walk through a little bit of what we're seeing as far as planning as it relates to the audit clients and what they should be considering.
Yeah, no, I think there's a couple big issues that are unique to this year. Ginnie Mae, you touched on it, Ginnie Mae, the custodian testing. I think anybody on this call, as a client, we should have already reached out, but if you're a Ginnie Mae issuer, the custodian testing is required to be done on site. There's some weird specific rules, but we won't get into that. So, but Ginnie Mae came out and issued a memorandum saying, due to everything going on, we know custodians aren't allowing people on site, we'll allow alternative procedures, but they don't really define what alternative procedures mean. So, again, the accounting world has kind of talked about this, and I think that we can do most of the same procedures through Zoom that we would be doing in person. We can do it virtually. They can send us over, documents, that kind of stuff. So that's the big one that year in that's going to be a little bit different. Another one is last year. It's kind of like a perfect storm this year. Production's up, everybody's busy, everything's going crazy. It's probably going to be like that in January, February, stuff like that. But we have no extension this year, or that not that we know of as of yet. Last year we had the 30-day extension for HUD purposes. You technically still had a warehouse line covenant that probably said you needed to get it 90 days after year end. But for HUD purposes and Fannie purposes and Ginnie purposes, you don't have that 30-day extension this year, which are, in MLS and everything. So that's where it's really, everything has to be done this year, 90 days after year end. So by March 31st. So just being prepared, being prepared now, getting stuff ready, being as prepared as possible, with production up and everything. I think that's, another key. We talked on MSR values a little bit in the tax piece, but just on the audit side of the, house and the accounting side. Just remember, if you're on fair value, you do need to book those to fair value, regardless of what you think or want to be conservative or whatever. So if you're on fair value, you need to be marking those to market up and down. Which this year there's been some significant swings. From March, April, through now. Stuff's increasing again. So make sure you're booking those. But values do seem to be coming back around. If you're on amortized cost, it's not probably at this point, it's probably not as big a deal because your values have probably come back up to that amortized cost amount. So just remember to get those valuations. If you haven't done it quarterly or monthly, make sure you're getting it for year end. That is something we're going to ask for on all of your, on all your whole entire portfolio, whether it's purchased or originated or whatever. And then I think really the last piece isn't necessarily a current year audit issue, but it is something that just to be, just to make note of. Just get ready for the lease standard. This has been preached over and over again. Leases are coming. It got delayed again because of COVID, but it is this year is the year unless again it gets delayed. So be ready for that and start. If you haven't yet, start getting your leases, documented, terms, getting, a lease management system or using your accounting system if it has that. But yeah, that's just a kind of a future thing to get ready for next year. So I think those are the main things for this year, Mark.
Yeah, what it also reminds me of is some of the basic things. your QC reporting, and make sure if you're outsourcing your QC that you're getting that put together, that you're getting those reports back. I'm sure a lot of those companies are behind due to volume, so get those in. Your total audit for our GSE approved lenders out there. Make sure your total audit is current, up to date. You are doing it. You have it documented. Something we can look at. We can help you with all that stuff, obviously, but just know that that's part of it. For those of you who are asking about what the lease standard is, we're happy to share that with you. We'll talk through that a little bit. It's a lease standard gap, the change in method. It's been circulating for many years, and
especially if you're a retail shop. I mean, retail shop, that's going to hit
Yeah.
you pretty hard. I mean, if you have branches all across the country that you have leases on, I mean, it's going to be a big undertaking.
Yeah, talk through it. Maybe give everybody a couple minute overview what it looks like and how that's going to be.
Yeah, I mean, basically, currently, I think everybody's aware of your operating leases. You run through your P&L. As you pay your rent, you expense rent. What the new standard says is you're pretty much treating them much more like capital leases. So you're going to take those operating leases and you're going to put them on your balance sheet. So you're going to take a discounted cash flow fair value, for lack of a better word, of that future, what you're going to right to use that asset over the life of that asset. You're going to put that on as an asset and a liability, and then you're going to amortize off or depreciate off the asset, and you're going to, as you make payments, reduce the liability. So, it really is taking it, and putting it all on the balance sheet. It could, I think most warehouse banks and everybody's up to date on this, so they know they've probably taken, this into account on, covenants and stuff like that, but you are going to have another, big liability on your books that could, impact liquidity ratios, current ratios, debt to equity ratio, stuff like that. So, yeah, I think that's a brief summary. It gets much more detailed than that, like everything, but that's, definitely the brief summary. So,
all right, good. Thanks for that. So I'm a mortgage banker. I've made a bunch of money this year, trying to figure out what to do. Some basic, some important things we want to make sure that you looked at. There's R&D tax credits. I think a lot of clients actually are involved with that. We have some clients that are benefiting from particular state tax credits. So making sure that that's been looked at. But John, is there any, I think people always want a silver bullet, right? On paying taxes. I read a book one time that said that the number one KPI to track if you're successful is how much taxes you paid. And I always want to push back and say, no, I don't like that idea. But do you have any thoughts on any ideas, and make sure that that you've looked at a particular areas to reduce your tax liability for 2020?
Yeah, I can just kind of quick fire talk through some issues. You mentioned the R&D credit. We find that many of our clients are developing softwares. They're developing their own LOS and various other processes, and there's technical in nature.
Yeah, customizing their LOS for them, right? Yeah.
Right, exactly. So a lot of those types of expenses would qualify as qualified research expenses and be eligible for the credit. So, on a timely filed tax return, you're getting the value of the credit and the deductions. So it's kind of leaving money on the table, not to at least take a look at that. In California, there's the California Competes tax credit has been around now for almost 5 years. It's been really successful, and effectively what it is it's a merit-based application that you apply for the credit, and California takes a look and they say, okay, are you going to grow? Are you going to add employees? Are you going to move here? And they'll give you a credit to help offset some of the profits, the taxes and the profits that you're going to have to pay living in the state that is really expensive to live in. So those are a couple examples of credits. And I mean, there's other states have similar types of incentive programs, sometimes in the form of credits, sometimes in the form of grants. So it's really just a kind of a case-by-case basis to look and see what's available in the locality that you're in.
Are we seeing any trends this year from any particular clients doing one thing or another?
Well, yeah, I mean, I think we're seeing formations of a lot more of charitable trusts, given the low, what are called Internal Revenue Code 7520 rates. They determine the schedule of future payments required as part of the lead trust, and also the value of the annuity, which is effectively the value of the deduction that you take on the tax return. So there's some opportunity there. So we're seeing a lot more of that. And then, I mean, I think, just looking at just the standard things, I mean, maxing out salary deferrals, and making contributions to employer contributions to qualified plan accounts, reimbursing employees for business expenses through an accountable plan. You have to have a written accountable plan in place to be able to do that. But if your employees have business expenses, you can deduct those and reimburse them for them. A commonly overlooked one is the one referred to commonly as the Augusta rule or the master's rule, where you rent out your personal home for 14 or fewer days during the calendar year, and you're renting it to your company, and your company picks up a deduction, a deductible expense, and because you're under that 14-day limit, you're not picking up any income. So that's another one that I often see left on the table. Just a couple of points on that. There's got to be, business purpose, a written agreement in place, and a readily established market value, which you could easily find going on Airbnb or a VRBO, et cetera. Couple of ideas there.
Great. From an administrative perspective, Dustin, how are we approaching fieldwork this year as we enter in the busy season? What are we finding our clients are comfortable with, or what do we think that's going to look like?
That's kind of an interesting curveball question there, but
I know it's not on our list, but
No, I mean, I think obviously we've been talking to clients, so it's not a hard question to answer. I mean, I think a lot of clients we've talked to still aren't going, but back in person and stuff like that. I mean, our audit we can do remotely nowadays. I mean, that's the nice thing about it is that, I mean, we're glad to be there. If you want us there, we're glad to come and sit in a conference room, meet with you for certain things. But, a lot of the stuff can be done, through Zoom, through, we have a secure portal that, you upload just like we do in interim. So yeah, but I mean, I think a lot of our clients, are either back in very limited capacities or still have a remote workforce for the most part. So yeah, so I mean, I think that's that.
Good. I'm hearing some noise in the background. I'm not sure what that is, but yeah, that's
sorry. Yeah.
We are likely looking at a change in the White House. I mean, it's looking, I know there was some bifurcated electoral college votes and who knows really, but it's looking, if I had any money to bet, Joe Biden's going to be our next president. Let's talk about what a new tax code might look like. I think the Qbi deduction might be at risk, some other things, but maybe John, you can talk a little bit about that. And yes, Jim, that question you asked, absolutely, I do that. But go ahead.
Yeah. Then there's a lot of proposals on the table, some not very well defined. The main ones are increasing the corporate tax rate by to 28% from 21% for C corps. Increasing the top tax bracket back to pre-2018 rates of 39.6%, and to reduce that reduce the top tax bracket to a lower income limit of $400,000. increasing, paying FICA on wages over $4,000. Currently, they cap out at $137,700. There's a proposal to tax capital gains as ordinary income if your taxable income is over $1 million. There's some good news as well. Repeal of the $10,000 state and local income tax itemized deduction. That could be a good thing for a lot of people. I think it was, the idea behind that was that it adversely affected a lot of middle class people, and I think that they wanted to be able to take advantage of that. And of course, living in California, we were definitely harmed by that because we pay a lot of taxes here. Yeah, I mean, there's a number of other things here. I think, restoring electric vehicle credits, eliminating passive rental loss rules, et cetera, et cetera. I think, but those are the hot button ones that we've talked about.
Yeah. So likely, seeing if they get it through Congress, more than likely taxes will be going up, regardless of. I think that $10,000 limit on income taxes for deduction against federal income tax really hurt kind of the higher W-2 earners, I would say. That was the one category that got hurt the most, but pretty much everybody else had a tax break. So we'll see how that turns out coming up. Let's see, anything else that we should consider here? John, Dustin, you sent me an email. I don't know really what that is. What was the question on that? As we're going through here, maybe ask John. Is there
No, I don't think that's a question. Sorry, I think that's what we still need to address internally a little bit.
Okay, fair enough.
Yeah.
Well, that's good. We're about 3 minutes away from this. Anyhow, if there's anybody who has any questions,
we have one question mark for John. Are we at risk of losing the $11 million per year state tax exemption? And if we are, should we gift now?
Are you talking estate tax? Yeah, it is. That is also on the potential proposals for the Biden administration. Yes. So regardless of what happens, 2026, the estate tax exclusion is going to go back down to 2018 levels, just as part of the Tax Cuts and Jobs Act. When it was passed, it was by making a lot of these changes temporary for 10 years, they were able to get them passed without bipartisan support. So that's going to happen automatically, no matter what. But the Biden proposal is to reduce the exclusion to 3.5 million for estate and 1 million for gift taxes.
And there's some unique planning strategies related to that, how you can put together your estate to get some benefit from that. So just know that we talk a lot about the various issues. Really, these webinars we're not. I think they're a way to know that there's a lot of different things you can do. Reaching out to us to do a real in-depth plan is something we can help work through. So just know that, and know that we want to help you. Oftentimes we get to the end of the year and we're pushing hard to get stuff in. So please make sure that you reach out to us and let us know. We reach out to you, but keep that in mind that we're here to support you, and that. I really appreciate everybody joining the call and allowing us and trusting us with taking care of you. To us, it really matters. This is an effort to make sure that we are invested in our relationship with our clients, try to give you as much information that we feel that would be valuable to you. What will make it more valuable is you letting us know what you want to know about some of the other things. We know you don't know what you don't know, so we try to give you that information, but likewise, please inform us. And with that, I'll turn it back over to Casey and Rachel.
Well, that was unexpected. I'll improvise. Well, thank you all for joining. Like Mark said, we definitely are trying to add value for our clients and make sure that we're really staying in front of some of the topics that are always top of mind. So Let us know if you have any other ideas. Thank you so much for your time. Happy holidays. Mark wants to say something, I can tell.
What's our next topic? We have one coming up in a month. Do we have it set already?
We don't have the actual date, but it's going to be accounting department efficiencies, and we're probably going to be partnering with one of our vendor partners just to kind of chat through some different software efficiencies. And we're going to have a great data table that's going to kind of show average accounting department sizes and things like that.
Yeah, we're doing some cool benchmarking as it relates to size of company, size of accounting department, and setting some expectations around that. So that should be a really good one. So that's it. Thanks, you guys. We're 1 minute over. Darn it. I am sorry to get back to you. Enjoy your day. Happy holidays. We hope you have a great new year. We like the production of 2020. We just like 2021 to be a little different. Hopefully we get a break from some of all the chaos this year. So cheers. Thank you.
Thanks, guys.